Okay, we're going to start a panel now that is focused upon distributed ledger technologies and post-trade processing, which as a capital markets person is of great interest to me and many of you in the audience. We're going to have the panel moderated by Neill, who is the head of North American development. And on the panel, we will be including several different people, such as Sunil Challa from Barclays, Artem Korenyuk from Fintech strategy at DTCC, and Todd McDonald from R3. Have I missed anybody?
Nailed it.
Nailed it. Okay, thank you.
Good pronunciation, by the way.
Thanks. Okay, over to you. Thank you.
Before we get started here, I know you just introduced us, but we can kind of go down the line and explain exactly what your position entails. That way you know who's talking and the perspective in which they're coming from for the panel.
Yeah, sure. I'll start off. Sunil Challa, I'm in the strategy and business architecture team at Barclays. I focus on derivatives and in relation to this conference, like what are like some of the use cases where we can potentially avail distributed ledgers, blockchain, smart contracts, etc. I lead an industry effort on standardization with ISDA for post-trade processing.
Hi, everyone. My name is Artem, and representing DTCC's Business Development Group and Office of Fintech Strategy. In that capacity, I lead our research and market intelligence gathering efforts around a variety of emerging technologies, distributed ledger blockchain being one of them. And I guess my day-to-day kind of looks like I walk around, meet with various areas of the business and their respective clients, and basically say, why blockchain all day? So.
Hello, my name is Gangesh Ganesan. I'm founder and CEO of a DLT startup out of Silicon Valley. The name of the company is called PeerNova. We started the company in 2013. And typically when I introduce myself, I say it is before Ethereum came about and well before many of the other DLT and blockchain ideas have come about. Our thesis, we build a DLT platform, and our basic thesis is that today there's a lot of complications in large financial institutions, CSDs, CCPs, primarily because of complicated data. And they're all trying to figure out how to actually manage all the different data, trade data, reporting data, or any of their other data in a simplified fashion. And we believe that this technology allows you to simplify many of those challenges. And that's kind of what we set out to solve.
Hello, everyone. I'm Todd from R3, one of the co-founders. R3 is an enterprise software company. We have an enterprise blockchain called Corda, which just celebrated its 3rd birthday, so not as old as PeerNova, but in blockchain years, I think it means it's 21 years old. The Corda was designed with a group initially of financial institutions, and it really grew out of the need for DLT and blockchain to address the problems and the requirements of the financial world. Since then, it's emerged as a general purpose platform. It's been open source for 2 years. And up until about 2 months ago, I was running our partnerships. In fact, I think on the agenda, I'm head of partnerships, but I resigned from that post 2 months ago because we have around 175 partners that were growing that space, and now I'm focused on digital assets, which includes on-chain settlements, tokenization, asset-backed tokens, and security tokens.
All right, perfect. Let's get into some detail here. So when we think post-trade processing, we think clearing, settling, all the details in between. And so Sunil, given your position and what you do, I want to start with you. What are some of the inefficiencies that lie within current tech with post-trade processing? What makes it so costly, and what does DLT promise?
Yeah, sure. Before I get into the inefficiencies, just in terms of some of the steps and functions that you have outlined, there is a general recognition that most of what we do in the post-trade world is commercially non-differentiated. So the question is that then why do all the participants in the ecosystem try to do this by themselves. So it's the banks, it's the clients, infrastructure providers, CCPs, regulators, everybody. So in terms of our journey through DLTs within Barclays and blockchain adoption for potential adoption for derivatives processing, what we have noticed is that the fundamental reason for the inefficiency is the duplication of the steps across the echo chain. And the reason for the duplication is because we do not agree on what the processing steps entail. We do agree on data standards like FPML, for instance, which is predominantly like the payload in the front to back of the derivatives processing. But each of us would take that data representation and we try to process that within our shop. As a result of which, what would happen is that if you have a bilateral trade, you have like two parties to the trade trying to replicate it. Probably the regulators come in at the end of that from a reporting perspective. Now if you add like a middleware provider, a CCP, a venue, etc., the process just sort of explodes in the duplication across these participants. And it's not so much that the technology is inefficient, it's just that people till now haven't really come around to saying that it really doesn't benefit anyone for each of us to be reinventing the wheel internally and trying to reconcile every single step all the way through the life of the trade.
Sure. Artem, let's go on down the line. So over the course of the past over a year and a half, the DTCC has done a lot, especially within settlement times. You think T2 settlement times. What did that look like within the post-trade processing system, especially within these inefficiencies itself?
Yeah, sure. So actually, before I get to that, one point I'd like to add, completely agree with your points. The one part that's more interesting is, or also interesting, I should say, is the elimination of reconciliation, or the reduction of reconciliation is great, and the need for standards to develop common workflows and processes is important, but the part that's most interesting is not the data sharing component, which you technically could solve with standardization and traditional technologies. This is the why blockchain hat, ready? But the part that's more interesting is when you actually start programming the life cycle, the workflows, higher up the chain, and what you're essentially doing is you're not just agreeing on what it looks like, but you're also able to orchestrate when it happens. You're synchronizing the actual timing, because timing is a big component of reconciliation as well. So that's the part that's most interesting to me with distributed ledger tech, as it allows you to climb up higher up the chain. So I just wanted to add that. The T2 settlement concept, the industry recently moved from T3. It is T3 in other areas, and it's not entirely a technology issue. Now, this may sound like a talking point, but the matter of fact is DTCC or DTC today supports T0 settlement. If somebody wanted to do a real-time gross trade concept, there's not a single line of code that needs to be lifted. It can be done. Now, can it be done differently on a ledger? Can you have more atomic swap concepts with the DVP if the cash leg is actually on a ledger? Absolutely. Not rehearsed. No, not at all. So the part that's interesting is, to me, as I look at it kind of as a business person, is it's very important to kind of steer away from the hype and break down every business problem you're trying to solve, and then evaluate each one. Get ready for this. Why blockchain? And for some of those problems in isolation, there is a better, more efficient solution. But when you take a step back and bring all of these problem statements together, the DLT component, the integration of the network, allows you to address more of them in the longer term. So just wanted to get this out.
So if you look at on settlement time, so previous to this I was an FX trader, but long since retired. The statute of limitations on any lawsuits are expiring. So in Canada, so the Canadian dollar is T+1, US dollar is T+2. There's absolutely no reason for the difference of the two. It's not like one system is more efficient than the other. It's just a market convention that everyone agreed to, I think is the important part. So I think that's that's also important when we talk about post-trade, we talk about how to apply this technology. In 2018 and 19, it is moved on a lot from 2015, where I think and especially on the market infrastructure side, and DTCC has advanced their thinking a ton over the last 3 to 4 years, and a lot of it by doing. But I think the trap a lot of people fell into was, okay, great, let's put a blockchain on it. Let's take this let's take all the exact workflows of this, let's say, large equity processing and just map it to a blockchain, and will have magical results at the end of it. But that's not the fun part, because why should we just map the existing processes onto a technology that allows you to do things in a much more peer-to-peer fashion?
Yeah, it's an interesting sort of time in the industry. For a long time, it looked like people were somewhat content with the idea that you can have disparate systems, you can have many different standards, and everybody does their own thing. What this movement has brought about, the DLT movement, blockchain movement has brought about to the capital market essentially is the recognition by all of them, by all of the major players that as the earlier comment was, remove some of the duplicate processes, but can I truly digitize the process? And so in that case, can I truly fundamentally change some of the workflows that are in place? Can I do things differently? So it's not about just going and saying, there's some code written today that implements a particular workflow. Can I change that code and code it using a smart contract language? That is not the point. The point is actually to more break down and understand what is the workflow about, why does this workflow even exist, and what are you actually doing? And now, can I make things fundamentally more efficiently? Can I make things better? Can I truly reduce middle and back office costs? Just as an illustration, one of our customers that we've been working with for the last year and a half, implementing a platform at scale, literally have 10,000 people part of a trade exception workflow that they do across the different asset classes. Just to think about it, 10,000 people is a lot of cost. Just coordinating how to do this exception management then itself becomes a project on its own. So rather than go and think about it as, how do I automate the exception flow, which is one part of the problem. It's like, how do I even eliminate the exceptions in the first place? How do I actually re-architect the whole platform in such a way that you don't have exceptions of the same form that you have and you're trying to eliminate. So that's sort of the vision and goal and sort of the problems that we've seen and chosen to focus on. And many of us have chosen to focus on particular problems, and in our case, this is sort of the problem area that we've chosen to focus on. Rethink the flow so you can actually re-architect, the digitization using DLT and blockchain.
Okay, hold on. Since we're on the issue of standards, Thomas Zeeb, he's the chairman of the ISSA, the Information Systems Securities Association, said that the tech is ready, but what's constraining the progress is that there is a lack of standards and that no one can even agree. So where do we find, first off, what are these standards and why the heck can't we agree?
Yeah, so the good news is that there is agreement. There is a prototype of the processing standard for derivatives that was released by ISDA in June. Barclays has conducted a hackathon, which was almost like a crowdsourced POC, because we wanted to make sure that there is immediate feedback on the standard, its application, and the question whether the tech is ready, because there is mixed feedback on that as well. So the standards are evolving. The application of the standards in terms of like whether it is DLTs or enterprise platforms, that's being tested. Just if we take a step back, like what does the standard attempt to do, to your question, is that if you were to take, which we did as a group within ISDA, if you were to take the entire front-to-back processing of a derivatives product, and we looked at like 5 product classes, there are about 150 processing steps that we do. If you then take each of those 150 processing steps and really translate them into state transitions, there are not more than 12 to 15 core state transitions. So what we have attempted to do through the common domain model as part of ISDA is that to take these state transitions and say that if you throw a set of inputs to these state transitions. There are some validation rules that run, and you are going to be guaranteed a deterministic output. Now, why is that so important in terms of the post-trade processing is that if you then take that standard and put it on a DLT platform, an enterprise platform, a market utility provider, etc., we are at least guaranteed that the workflow is standardized across these different vendor platforms, and we don't have to from a consumer perspective, the problem we have is the fragmentation of the solutions and the amount of money we spend in trying to reconcile across these front-to-back solutions is humongous. So what the standard attempts to do is that it will promote the commercial aspect within the value chain while preserving compatibility across those platforms. So that's kind of where we are with the standard, and it's being worked out for rates and credit derivatives, etc., which I can get to in a bit. But equally, in terms of the technologies, then we have a couple of DLT providers here. We have a market utility provider here. It depends on how these standards are actually picked up by the infrastructure providers and what is the critical mass that develops around these standards, and what do we get from the technology providers in facilitating that?
Yeah, I have a pop quiz for the crowd, just to check if you're awake. Before you came in this room, how many people knew what the common domain model was in derivatives? Oh.
5's good.
5 or 6? Okay. So this is so standards, what's the joke on standards? There's 14 standards. They want to fix it to 1, and then there's the 15th standard. So the challenge that we have is to try and figure out what's the right timing to standardize and what level of the stack or kind of what kind of standardization to have happen. But we need the industry, you people, to get involved and get behind the work that Barclays and others are pushing ahead for the common domain model, what ISDA is pushing for. Because the work has progressed an incredible amount over the last 18 months, right? It's been 18 months. And to the point where we as a firm, we are a for-profit startup. And so we're not doing anything for the common good. We're doing that in order for the industry to advance so that we can all build the enterprise blockchain space. And we've made a commitment and a bet on CDM. We've built it in as a primitive into Corda. Others, digital assets, doing the same. Others are doing the same. It's time for the industry to get behind it. It's good for technology vendors because it de-risks some things for us, and we can then fight where we don't feel we should be standardizing when it comes to technology approach. You know, Corda is very different than Fabric, Hyperledger Fabric or Hyperledger, and very different from Ethereum for very, very distinct reasons. But we think that when it comes to an interest rate swap or a CDS, if we can drive to some level of standardization, it helps the entire industry, including the vendors. So,
concur with this thought process. We, as a vendor, we sort of approached it, when we thought about building the DLT platform. We picked a big data stack that is very commonly used today, Hadoop, and all the other execution engines are based on standard big data tools, which are open source today and are very, very widely used in enterprise. So the goal was to actually make sure that all the data standards, either in terms of processing, storage, execution, all of it are absolutely standard around the industry. On top of this, we build other, abstractions. One of the abstractions is the DLT abstraction itself. The DLT abstraction now allows us to share this, allows us to create distributed state machines, and the CDM itself plugs right on top of that. So for us, the CDM type work is very beneficial because our goal as a software vendor is not to go and invent new things, that everybody struggles to adopt. So we want it to be easy to adopt. So for us, the CDM is a great thing because now, rather than coming and telling people, here's how the state machines need to be coded, CDM is already standardized and said, here are the steps you need to actually code in the state machines. They've already standardized it. So now, any application, any model that you talk about, whether it's Coda, whether it's our platform, we call it Cuneiform, based on Hadoop, are all using the same abstractions. And then the next question would be, from the abstractions, how do you translate down to the lower level details, which is, I think, is currently happening. The cryptographic hash allows you to sort of standardize across this, because it doesn't matter how you store the data. If you got the same hash, essentially it means you had the same object. It could be the same state, or it could be the same trade information. So we look at this as a great effort in the industry, and it's going to be a transformation that's going to be probably gradual, but we're looking for adoption from some of the early vendors to do it. So I think it's going to be adopted sooner than we believe, because most people are dying for something that's a common abstraction.
Now, the one thing I'll just say, one of the other things you mentioned was, or stated was, the tech is ready. And I think it's important to question for what purpose, for what use case. Now, I'm sitting next to two DLT platform providers, so watch them attack me right now. But joking aside, I didn't know that. I didn't know the tech is ready. So shameless plug, one of the things that we weren't sure about, and we believe the industry wasn't necessarily sure about, was whether or not the tech was ready for use cases of specific scale. Volumes is a critical component. One of the things that we're doing right now is we're implementing an actual production implementation of a trade information warehouse, and are working with the CDM model and ISDA to move something into production, something that's real, something that actually programs the life cycle of a credit derivative trade and introduces real efficiencies in the workflow components related to it. That's a smaller use case. That's something that we knew the tech was ready, right? And the successful completion of development is a testament to that. We're now moving into UAT and are looking to go live with this sometime in 2019. But that's a smaller use case. The value tends to be highly correlated to the actual scale of a process. Securities, the core business of DTCC in the US, was a fairly large use case. Now we're seeing some implementation of that in Australia. We're seeing some of that in Hong Kong. Those are also smaller use cases. So we as an organization, quite frankly, did not know or believed that the leading enterprise blockchains were not fit to scale to the likes of the US markets. One of the things that we did, and this is, I guess, the shameless plug, is we ran a study, we ran a test of taking two leading DLT platforms, one is represented here today, to essentially simulate or prototype our clearing and settlement system and do it in a distributed fashion, establish 170 node network, and essentially see where they start to leak, right? And we set a threshold of 115 million trades, not transactions necessarily, right? And we force-fed them in a fixed 5-hour period of 6,300 trades per second. So that's a lot, 6,300 trades per second for 5 continuous hours. We set that as a goal, quite frankly, not expecting to ever reach that goal. And here's the kicker. We reached that goal, and we basically decided to stop. Both platforms were able to successfully process 115 million trades. We haven't reached the ceiling for either application. So as of, I don't know, a month ago, I now do have certainty and comfort and understanding that from a performance aspect, the tech is ready. There are other tests to be done, but I'll just pause. I'll park
Was that a
there.
shameless plug for me or for you?
Yeah, for you.
Oh, thank you.
So I think one thing we wanted to sort of emphasize on this is, right, as we talk to financial institutions, much like DTCC and Barclays, we realize that, the scale component has many, many pieces. There's the piece where you have to actually, somehow ingest or get, say, 115 million trades in X number of hours in. But all the different users, all the different nodes are going to query the system and are probably going to ask for business intelligence, or are going to ask for operational requirements, or are going to ask for compliance reports. So now the system simultaneously, in addition, has to do all of this, has to do it securely, has to be able to support all the models needed for other systems to integrate with it while all of this is going on. So sort of, that's where the industry is now, a lot of us are implementing solutions that are enterprise grade, that can solve all of these, all at the same time. Because if you kind of think about, earlier there was a gentleman from Oracle talking about, broadly how Oracle thinks about it, but that's really how a bank is. there's lots and lots of systems that are going to be connected, risk or compliance or reporting, or all the regular operational users. And so you have to support all of the features as well, if you're going to be a market infrastructure, sort of a platform that's going to provide these features.
It's amazing. So like you think of, Bitcoin blockchain, the speed of it or the lack thereof, 7 transactions per second, is a feature, not a bug of that system, because it is a batch process, and it is that speed because of the what it's trying to solve, which is to create censorship-resistant digital cash or digital gold. It is not a problem that the post-trade industry across financial markets has. In fact, that they want the opposite. So the whole challenge for enterprise blockchain has been, how can you retain the benefits of a blockchain system where you can have what I see is what you see, we can have that shared truth across a market or an industry, but do it with the privacy and the scale needed for, there really is only a couple use cases like putting the entire US equity market through a blockchain. So that's like the big one. So hitting that, even though it was a bit stylized, even hitting that was a big achievement for the industry overall, because it's a signal that we're ready to move ahead, because you don't need those feeds and speeds for most of the use cases, but it's a great test. But it also shows that the approaches taken for enterprise blockchain are different. So from the quarter perspective, it is more like a transaction chain. It becomes pre-sharded. So you can then scale horizontally, which is much like how was accomplished within this test. The more nodes you add, the more throughput you can have, because you're not running batch processes. In fact, we're trying to get away from batch processes with what we're trying to transform within OTC or listed derivatives.
Sunil, I think I saw your wheels turning.
No, go for your question.
Okay, good. Artem, I want to come back to what you said. You talked about there's some activity in Hong Kong and Australia. You're talking about digital asset at the Hong Kong Stock Exchange in Australia. All right, so digital assets, a DLT startup, and I think has a somewhat of a relationship also with the DTCC. They partnered with the Hong Kong Stock Exchange specifically to build or experiment with a platform specifically for post-trade processing. Is this too soon? Is this, it's about time? And what is the benefit? Should we be encouraging this adoption here in the United States at this current state in the technology?
So I'm not too intimately familiar with the specific relationship that was established between DA and the Hong Kong Exchange. To my understanding, the northbound volumes that they're really focusing on right now is fairly narrow. It's sort of a link between the two markets that allows you to trade between. So it's not to the likes of what Australia is doing with DA, which is a broader replatforming of their existing chess clearing and settlement system end to end. So no, there are certain use cases where the tech is absolutely ready, or the use cases fit the capability of and the risk tolerance of the tech and the regulators in that market. DTCC is obviously looking at the space very closely, and one of the reasons why we ran the performance and scalability test modeled specifically around the cash equities model is to validate a misnomer, essentially, right? To answer an unknown for us. Now, is that the only unknown that we have? No, there's a number of other things that we need to do around testing the resiliency of these platforms, the privacy and security. And then the more interesting thing is, as we look at how the systems solve for the performance problem, what are the architectural decisions that they've made, and at what compromise to what has to actually happen? So we're planning on doing more tests. We're planning on learning more about the tech around use cases of higher scale. So that's kind of our next step there. So the tech is ready for some use cases, not necessarily for all.
I think it's important to have the perspective of what the use cases are trying to solve, whether they are localized and where the efficiencies are localized versus where there is a network effect from those use cases. So the examples that you have suggested are fairly localized. So for those exchanges, there is a process optimization that you can get, and there is an efficiency gain that you can get. But if you correlate that to post-trade, you need to have a network for those efficiencies to work out, which means that you also have to recognize that not everybody in the post-trade space is willing to go through the journey with the blockchain. You have to figure out that there would be some sort of a transition to this where enterprise systems would coexist with blockchain, DLT, smart contracts, whatever it may be, and that even within a firm like ours, that transition, when that happens, is going to have like a coexisting sort of the legacy platform with the new platform. It is never a rip and replace play within the institutions that are participating in this ecosystem. So the question, I think, in terms of what I was referring to earlier, the feedback we have received from the participants is that what are the platforms doing in terms of facilitating that transition? So if each of the platform, behaves and operates in a different way from a DLT perspective, it would be very difficult for an individual firm to say that I'm going to bet everything on this one platform. That again is very unrealistic to say that in a commercial enterprise of this value, you are going to pick one ring to rule it all. Never going to happen. So you have to think about even if interop is not possible, then what are the other ways you are going to skin that cat to say that if I have like half a dozen platforms, how do they all work together? And I think that's the big technological challenge that we would have to cross before there is a broad-based adoption of these platforms.
So I'll comment on that. You know, the first two use cases that we've actually solved, and you know, we'll get ready to announce them very, very shortly. One is
this is PeerNova.
PeerNova both of them actually involved efficiency gains. You know, that those institutions felt they could gain with this technology while the rest of the network and the industry is catching up. So what that basically means is that in these use cases, they have multiple internal systems, multiple legal entities, multiple reporting entities, multiple entities that cannot actually see the same data simply because of privacy concerns and EU-related concerns and other stuff that they have. So in a sense, they're actually building this network initially internally for themselves across their own different entities, and then waiting as the industry is sort of catching up, they're participating in it. So the first two use cases that we've taken it all the way to completion are actually use cases like that. Now, traditionally, the industry looks at it and says, well, that's not really a DLT because you haven't brought all the network together yet. But, you know, we are kind of saying DLT is a name. We can call it whatever you want, but they've actually sort of started the digital transformation of bringing this type of technology, this type of data model, a data model that adheres to something like the CDM, which says, you know, here's my current state, here's the transition or the state transition function, here's my next state. So that across my internal systems, I've already built this abstraction. Now when I go to connect to all the other network participants, it's going to be that much easier. So that's sort of point number one. Point number two, which is concern about all of this, how does it all interoperate? You know, first thing all of us have been trying to do is sort of, you know, learn the core technology, make sure that the application really fits the technology. If not, don't go down that path at all. Just try and apply for use cases that are right. But in the process, we've learned standard tools. For example, in our case, in the PeerNova case, all the querying is done using SQL. Why? Because SQL is the way by which today all of the enterprises work. So if I have to query data that's in a chain, if I'm not using SQL, it's going to be non-standard. How do you, you know, bring data into such systems? How do you actually do that? Well, we support standard ETL models. So if there are other systems, enterprise systems that need to talk to you, or you have to connect to existing enterprise systems, you need to do ETL. How do you extract the data from those systems? How do you transform them and load them into such platforms? So we've kind of tried to support these standard models and also use standard tools wherever possible. You know, programming languages. Don't try and invent new languages. Try and make it as straightforward and as simple as possible. And where possible, can you generate code automatically for people out of standard templates? You know, like the CDM model allows you to sort of have this higher level abstraction, not think about lower level details, because that can be provided either as a library or as a set of tools that upper level applications can be built on. These would allow more interoperability, and these would allow faster adoption in the industry from our perspective.
Yeah, adoption's happening. It's happening today. You mentioned around exchanges, right? Are they ready? I think, and also from an adoption, Sunil, we've talked about this before. If it is an adoption game, how you try to get participants to onboard. And market infrastructure is going to play a key role in this because, especially for a bank like Barclays, they already are connected to LCH. They're already connected to DTCC. So it's an easier onboarding path. But I think what the exchanges are doing now, market infrastructure is doing now, it's sort of, I think the entire blockchain space was sort of, you come for the cost reduction, stay for the revenues. I think that's where that's where the excitement's gonna happen. And if you look at, with Thomas Eve, you mentioned he's the CTO for Six Exchange. They are investing in a clean sheet, new digital exchange that is trying to embrace this new technology in a novel way to, in effect, tokenize all the assets that they trade within their exchange. They have over 100 participants, so they have an inbuilt platform to launch something new. Deutsche Börse, who's invested in a partner of ours, HQLX, they are going live in Q1 with HQLX to, in effect, create tokens of baskets of securities for participants to swap amongst themselves to optimize their balance sheet. This is all happening today. This isn't something down the road. TIW is going live next year. It's already in testing. This is happening now, and I think what we're starting to see is maybe the banks came to this from a cost play, sort of mutualize costs. But what some of the market infrastructure and exchanges, they see dollar signs, and that's where we're going to see the acceleration in the adoption, because it's way more fun to make money than to save money, in my experience. That's what my wife tells me too.
All right, so this is great for, especially for those engaged in the processing like capital market firms. What effect does this have on the actual market for the end user?
Well, it's a good question. When we try and describe some of these complex market infrastructure, applications, most average users in the street, not on Wall Street, anywhere else, wouldn't know it. For example, 5 years ago, if you went and asked most people, whether you knew DTCC, they would say, well, don't know. Some kind of exotic entity in New York, maybe they knew of it as that, right? So when you look at these kinds of problems, the real benefit for end users eventually is lower cost. And I'll give you a simple example of it, right? If I'm an end client, right? Let's take an end client of who connects to this kind of an infrastructure. Let's take a company like Cargill. For those of you that are familiar, Cargill is one of the largest agricultural companies in the world. They're based out of Minnesota. Because they trade in grain, they want to, say, soybeans, wheat, things like that. They're a very, very big user of the commodities and futures market. They come to someone like CME, and they want to hedge and buy futures against corn or any kind of grain pricing, because they don't know what the grain pricing is going to be next year. They don't know what the harvest is going to be this next year. So they want to actually lock down those kinds of pricing. So they're an end user. Given the inefficiencies in post-trade processing around the world, it's Cargill that's actually paying a high cost for actually making a futures trade. If Cargill is paying a high cost, then finally all end consumers of grain, soybeans, wheat, which is all of us, presumably, maybe me more soybeans than others. I'm a vegetarian, don't drink milk. I use the soybean example. But nevertheless, the end cost is for all of us. If the financial plumbing today, the costs are borne by, say, JP Morgan's and Bank of America's and Barclays of the world, that is eventually coming down to all of us. It's coming down to, fees we are paying or eventual end product costs. So having this efficiency in this, in all of these systems you're talking about, eventually will translate to, more efficient use of capital, in the broader economy, in this class at least. There are other applications where end users are directly touched, but in this case, end users are indirectly touched, but nevertheless the benefit exists.
I think even in this use case, end users are directly touched. It's just that depending on the maturity of the clients, we see that some are actively engaged in investing and exploring these technologies, and as much as revenue is the king, they are also worried about the cost that they are spending on producing that revenue. So everybody is after the same thing, that how do I maximize my investment in technology and operations so that I can run my business more efficiently so that I can deploy the capital on a revenue generating product. So the thing again is that what we have seen with like some of the thought leaders on the client side, I don't want to name names because I'll get in trouble here if I pick some clients and not others, is that they are also looking at their entire infrastructure stacks, and they are saying that to the point you've mentioned earlier, that yes, there is a benefit in sort of fixing your own shop, which is the internal adoption of like a DLT platform, which generally is referred to as a front-to-back operational database, so that you have a permission database which the different functions can source from. So that's like a sort of a baby step in the direction of travel of a more industry-wide adoption. And people are doing that. But the main challenge for them is that what happens next? What happens next is very dependent on at least some critical mass getting developed in the industry and sort of coming together and taking one use case and saying that, can I solve this use case across a core set of sort of like-minded participants with the technology partners, with the infrastructure providers, so that we can positively demonstrate that the material benefits are there, and by bringing these technologies in, I'm not spending on like a 5-year or a 10-year adoption cycle where I have to maintain my legacy platform and I have to also maintain this new technology, which the cost of running a node, I heard, is not cheap. So which will add up to your cost. So that's, I think, where I would see in the next sort of 12 to 18 months, some of the use cases develop in the industry, and some of these things, once we move from like the performance throughput kind of questions, it becomes more tangible that how do I make this, how do I deploy this in the internal stack, how do I run the legacy and the new technology in parallel, and where do the costs come out to be?
Yeah, the one thing that kind of might jump out at you as I was listening to Sunil is, with the market infrastructure providers or market utilities, when normally you would probably, coming at it from the outside, would think distributed and maybe decentralized is in the name, so why are market utilities still in the picture? Is this just a way to kind of save face and survive in this new changing reality? Well, Todd alluded to the fact that, you know, censorship resistance is not an absolute requirement here, right? Dealing with trusted and unknown parties is not a requirement, it's quite the opposite. So because you don't have to solve for these two core problems in the public space, then it comes back down to what is the most efficient way of solving the problems that you have. And in certain cases, a utility, kind of biased here, but a utility brings efficiencies through some elements of centralization where it's necessary for whether it's processing certain components that shouldn't be distributed, whether it's governing a network to ensure all participants are equally represented, whether big or small, or dealing with participants that may never have the cost benefit of actually adopting a node and being an integral, intimate part of the network. So it's just, again, where we started as the pendulum swings from one end to the other, the disintermediation of everything for the sake of disintermediation. The pendulum's starting to shift and balance, and we're now starting to be a little bit more sober about this and focusing on, let's find the most effective and efficient solution for the problems at hand.
Yes, but I guess, I mean, it was interesting, we were talking about, like, the man on the street's not going to have a benefit for, 10-year swaps being processed more efficiently, or even cargo making more money. But there still is a need for moving to more, we have the ability to move to a more peer-to-peer market structure. So that, for a central utility, it can move to maybe different levels of the stack governance and all that. But I do think that it's going to change the way markets behave, because this is a peer-to-peer technology if it's architected correctly. So we should start to think about new ways to democratize access to capital. So you think of what were ICOs? ICOs were a massive experiment with other people's money. But what it was an experiment of a company seeking capital, finding someone looking to allocate capital. Now it was, Banana Coin looking for Crypto Bobby to give him all of his ETH. But if you strip all that away, there is a strong lesson there. It's the beginnings of a more direct and democratized capital market. And so I think that's what we can start to move to. And I think even bringing it back to the swaps example, we've all experienced over the last few years, the buy side and sell side designations are starting to fade away. So it's one big messy mass of just market participants. And so banks and asset managers are all trying to figure out how they fit together. And it's only going to continue. It's only going to get mushier and messier. It's only going to move more peer-to-peer. But luckily, why blockchain? We have a piece of software that can help be organizing principle when we move to a market condition where there is more of like-minded peers that are transacting amongst each other.
Especially on the cross-border pieces.
True.
I think the idea of decentralization and sort of distributed ledger technology, while people sort of sometimes commingle these two topics, there are use cases which are lending themselves more easily to peer-to-peer, right? There are applications which you can look at, think about, and say, well, we can learn from, say, the Bitcoin, sort of core protocol, Bitcoin applications, and say, here's sort of a class of applications that lend themselves to this kind of P2P applications. There's a vast class of applications today which need some type of intermediary, today, but sometimes these processes that involve the intermediary aren't as efficient. So, if I'm DTCC, if I'm looking at other CCPs and CSDs, they're looking at ways by which they can sort of, lead in the adoption of it. They want to kind of say, we'll modernize the technology. We'll make whatever components of this that can be P2P, we'll make it P2P. There are components of it in which we add value because, there is need today at least, with the way the market governance is set up, there's need for, some utilities to play a key role there. So those applications try and figure out how to bring all of these together. The P2P idea together with the right enterprise idea, the right execution model, and the right components together. So that's why the term DLT, when all of us use it, it's somewhat, everybody defines it somewhat differently, right? Because we're all trying to find that right trade-off for the appropriate application. For the application, the DLT makes sense. If it makes sense, then use it. If not, look for other alternatives and stick to other alternatives. But when there are multiple participants and multiple systems that are sort of connecting, there is a good need for taking some of the common ideas and standardizing across them using this execution model that comes out of the original P2P learning and the DLT model. And that's kind of where we're all going.
Are we going to drop the DFMI term now? Distributed financial market infrastructure.
Real quick, last question here, and then I want to open it up for a short Q&A. You talked about all these standards, especially the common domain model. It really sounds like the financial institution, the finance industry, capital market firms, you name it. It really sounds like this is never really going to be any type of fully decentralized operation. Do you see this adoption happening? A decentralized transition and strategy?
Yeah, sorry.
No,
No.
Sorry. The no is not for that. You would, if you look at the network, you would require some sort of a third party to step in. By regulatory mandate, we need a CCP. So you can't just come into the market infrastructure and say that we are going to disintermediate CCPs. CCPs provide a particular utility, they provide a risk management feature in the market, which is now a regulatory mandate. So those would, I would say, remain for some time to come until there is a new regulatory mandate or until there is a new optimized way to do it. We have been conscious of this in terms of the development of CDM to say that it is practically open to anyone who would want to come and to echo Todd's remarks. It's a bit of a call to arms that we require industry participation. This is not going to be like a dealer-led or a fintech-led sort of a standard. To just sort of highlight it, there are webinars on how someone coming cold to CDM can start with the 101 principles and how they can build up, which are freely available on YouTube, Vimeo, whatever. And the essence here is that, again, it goes back to what I started my remarks with, is that this is completely commercially non-differentiated. There is no secret sauce here. How I do a reset versus how JP does a reset, or how I clear a trade versus how BAML clears a trade, there is absolutely no difference here. So there is, in this process, in the process of defining the standards and finding use cases where we can work towards efficiencies, if it means that some of the structural elements of the markets will change, most likely they will change, but nobody is opposing to that change. That change has to come a little bit organically across the industry participants rather than I think I was having a chat with few people at lunch, and the suggestion was that could regulators mandate this? It's not really for the regulators to mandate this. It is a industry ecosystem. Participants have to figure this out for themselves.
Right. So the question around sort of P2P elimination of central authorities. It's for the applications we're talking about here. It just is not easy to think of a scenario where you're actually able to say, here's sort of a currency representation that across the banks is going to be sort of standardized, and even in that case, even in a tokenized scheme where we are actually using sort of P2P ideas, tokenization ideas, that still is involving some type of a token issuance initially, and likely one of the entities is taking the job of actually issuing the tokens that are then going to be traded amongst the network participants. So the model where that initially people there's a group of people that started off with a thesis that says we're going to take everything and decentralize and disintermediate the whole financial industry. So 4 or 5 years ago in the panel topics, people would talk about elimination of CSDs, maybe even banks, and say everything is going to happen in some other way, whatever that way was. We don't quite see that, at least not in the near future. It could happen, down the line, say 5 years, 10 years, 20 years from now. But we all know technology cycles 20 years from now are impossible to predict. Certainly, even 10 years from now are impossible to even forecast or predict. So we're not going to make a statement here saying that all disintermediation ideas are bad. They may happen 10, 20 years, 20, 30 years from now. But in the foreseeable future, 2, 3, 5-year horizon that we're all working in, 2, 3-year horizon, we're not seeing anything radical like that happening. What we are seeing instead is market participants actually adopting and trying to become very friendly to this new idea of digitization and new way of thinking, which makes their operations efficient and eventually translate into lower cost for everyone in the chain.
Not to be a skeptic, but I would just say, talk to me when a central bank creates a national ledger and issues fiat entirely on a public ledger, and every person at birth gets a unique address. Yeah. Then we can talk about the broader disintermediation of capital markets and capital formation, which would be pretty awesome, pretty cool. I'd love to see it, but
it's a better ways away. At least that's what it looks like.
Also potentially dystopian, but we'll see how it goes.
Hey.
We got just a couple minutes left. Sure. We have time for 2 or 3 questions. Does anybody, especially if you're here with a capital market firm that's looking to change their strategy a little bit, does anybody have any questions? Sorry. Going once.
We're ready for your questions or your cat calls.
This is the end, bro. You're good.
So I come from an independent software vendor, and one of the reasons I'm here actually is to kind of look at ways that my company can get more involved in this space. And I was just thinking, I forgot your name, for the gentleman from the DTCC.
Artem,
thank you. Are you looking at anything in terms of like the regulatory reporting space? I know, like, for example, like swap dealer reporting, which is a pain in the ASS for most of our clients. Like, are you looking at anything in that space or anything like that in terms of proof of concepts or looking at work there?
so it's a good question. So we have a global trade repository which operates across a number of jurisdictions, specifically around swap dealer reporting or swap reporting. It's an interesting question. We've looked at that. TIW, which I talked a little bit about, is actually a feed into that for credit derivatives for a variety of different jurisdictions. What's different about that is, if you're familiar with the space, the regulatory requirements of what a reportable trade looks like varies across every single jurisdiction. And jurisdictions are still coming on board with new divergent requirements. So we talked a little bit about standards. There's a clear lack of standards as such. So the question will be, where is the most logical entry point to create those standards? And especially when you have to deal directly with regulators, that may not be the most logical entry point. once the standardization occurs, once regulators align on what they require, what they want to see, and when they want to see it, is probably, that would be a great use case.
It's definitely top of mind, and in fact, so Regnosis is the firm that worked with ISDA to help drive the design of the common domain model, and the reason they got involved was a means to an end, really, to provide regulatory reporting really as a service at the network level. So it's really just an output. But if you have CDM, if you standardize against CDM, the reg reporting is merely a trifle.
Yeah. In terms of going through the reporting use cases, which is actually top on the list for us from an adoption perspective of DLT technologies, we have spoken to several of the regulators, both in the US and also in Europe and UK. And they are also extremely interested in trying to figure out how they can consume basically transaction data of a node. And essentially today for when you execute a trade, on the day of the execution, we report about 5 versions of the trade. So for them, trying to figure out like which version is the correct version and navigate through that, it's quite painful as well. So that to me is almost like the lowest hanging fruit, where if we get to a DLT platform, you just open a node to the regulator, and to the point that we don't even need harmonization of the reporting rules, because depending upon which jurisdiction you can, that's the whole idea of a permissioned ledger, that you can put rules to say that if it is CFTC versus ESMA versus somebody else, you can show only the portion of the data that their reporting rules mandate. And we are actively working on those use cases. And part of like the initial adoption through CDM would be to get to that sort of a reporting node target state.
All right, we got time for one more. Going once, twice. Okay, thank you.
Thanks, everybody.